much for joining us for our customer forum today, which of course we're going to be focusing on the topic of powering the future. And I'm Gage Huston. I'm general manager here at Muscatine Power and Water. I've been with the utility for 22 years. I've been in the GM role for about 6.5 years now. This is a topic that's very near and dear to my heart because of where I came up through. But the bulk of the presentation today will be done by Greg Slonka, who's our Director of Power Production and Supply. Many of you have met Greg over the last year or so as well. Our agenda for today, I'll go through just a little bit of bigger picture trends in the electric industry right now to just kind of set the stage for power supply in general and how that applies to what we're looking at with our Powering the Future initiative here at MPW. And then we'll turn it over to Greg, who will go through our most recent results of our power supply studies that we do on a regular basis, some key takeaways from that study, what the recommendations were, and then we'll provide some updates on some of the projects we have going on related to power supply here in Muscatine. So a few of the bigger trends in the industry right now, I'll show some visuals related to many of these topics as well, but we continue to see price increases for electricity across the country, in addition to be related to things like just inflation, tariffs, supply chain issues. There are just a lot of big changes in the industry right now. So there's a lot of investments being made, whether it be retiring old units and building new generation, or substantial investments in transmission infrastructure right now. So it's driving price increases currently and in the years ahead. Also right now, there's a lot of pressure on the reliability of the system at large, and there's several factors that are driving that. One of them is related to larger load growth assumptions. Across the country, we've seen a couple of decades of pretty stagnant load growth. The forecasts right now are for more substantial increases in that load growth. I'll talk about that in a bit. But you also have that coupled with retirements of fossil-fired dispatchable units over the last several years, and more continue to be expected, being replaced with more intermittent renewable resources, and then clogged interconnection queues. So new generation trying to get on the system, but the grid operators are kind of stuck in study process and slowing those interconnections down. So all those things coming together are really putting a strain on the grid. There were a lot of changes with qualifications for tax credits for renewable energy projects that came out with the new One Big Beautiful Bill Act and the subsequent guidance that's put a strain on the timeline for qualifying for those projects. So there's a lot of uncertainty in the industry of which projects are going to qualify, which ones may not, and what that means going forward. And then continued regulatory uncertainty. You've seen this certainly throughout my career and many, many years before that. As you have these ups and downs in the regulatory space, makes it difficult to plan for the long term when things are changing. Talked about prices. This is some data from EIA. This is across the U.S. on average, all in residential price per kilowatt hour for electricity. So you can see going from 2019 forward here, the last 6 years, pretty decent amounts of escalation in price on the residential side, above a little bit what you would typically see for just inflation, and expected modest increases over the next couple of years as well. Just by comparison, this was for the last set of actual data that EIA had for August of this year. You could see our residential rates still substantially lower than what you see for U.S. averages. We continue to trend a little bit below what you see for state averages as well. So we're pretty proud of that. But just like with the U.S., we do expect to see continued modest increases in electricity prices. So what is making that electricity across the country? So this is a good stacked bar chart that kind of highlights where's that electricity coming from across the country. We've certainly seen significant increases in the amount being produced from wind, from solar, but the vast majority continues to be produced by a combination of natural gas, coal, and nuclear resources. And this EIA looks at the next 2 years in their short-term outlook, but in their long-term outlook, it continues to be a lot of the same. Continued increases in renewables, but the vast majority continue to be produced from natural gas, coal, and nuclear. Sometimes I've heard recently that the perspective that, well, natural gas as a fuel for electricity is really on its way out. That's not going to be around much longer. That is certainly not the case. That's not what the data shows. It continues to be a very important part of the generation mix and will continue to be so in the years ahead. One of the big storylines in MISO, which is our part of the grid this year, was their capacity auction prices. This is the last 10 years of capacity auction prices for MISO. Don't worry about the units of measure here, but what you can see is kind of unpredictable. Most years it's very low, almost zero, but then we've had these really odd spikes occasionally. In the most recent one this year, we saw it jump up again substantially, but MISO made some changes to their auction structure this year using a sloped demand curve, which they anticipate will help stabilize to a certain degree those capacity prices and elevate them in general, because they recognize that these near zero prices just really aren't appropriate. That doesn't really show the true value of capacity. So they do expect them to stay higher going forward. The reason there's an orange bar here is because MISO actually announced that they made a mistake. There was an error in the software that they used for the data for the auction, so they had to lower that price back down, but still a substantial increase from what we saw the last couple of years. This is a chart from MISO, again, that represents that change in load forecast from what we typically see. This has been typical across the country over the last 15 to 20 years, very stagnant, almost flat load growth. MISO actually saw a negative CAGR over the last 15 years. But look at what they're forecasting now, going from roughly 0.25% per year growth to 2.6% per year growth. That's a 10x increase, in terms of growth rate. You can see the bulk of what's driving that anticipated growth rate is the data center class. And these are huge projects, very large load pockets with these hyperscale data centers they anticipate to continue to grow. Talked about fossil retirements. This was planned retirements that MISO was aware of from 2025 to 2030. The big jump in 28 was related to an effluent limit guidelines regulation, ELG regulation. Greg will talk a little bit about this in his presentation as well. That year was a major milestone in that regulation that was driving a lot of planned retirements. What I will say is these numbers are probably going to change. Some of these retirements are set, they're confirmed, they're solid. But I think with the strain on the grid and with those changing load growth assumptions, I think you're going to see a lot of these units that may shift those retirement dates and possibly push those out. But the trend, the dynamic, will certainly continue. So with that kind of backdrop, I think it's important as ever. So our Powering the Future strategy was founded on this balanced approach to power supply. And we balance reliability, affordability, flexibility, and sustainability. And I think when you look at all those major trends and the changes happening across the industry, I think that balanced approach to this is as wise as ever to make sure that we keep the system stable and affordable for Muscatine in the years ahead. So with that backdrop, I'll turn it over to Greg Slonka. Greg, come on up.
Thanks, Gage. For today, I'll be reviewing the results of the power supply study that we completed in 2025, as well as some project updates for our big three projects that we've got around the room today with Solar 1, Unit 9, and EcoGen 10. The first thing I wanted to review is the background and how we kind of got to where we are today. And I think it's important to identify that we are part of MISO, which is the Mid-Continent Independent System Operator. And MISO's job is to provide the most value to its stakeholders, which is largely customers on the system that represent as loads. Muscatine Power and Water is a load-serving entity, so we buy and sell all of our energy at our local node. And so when we have an excess of generation, we're able to sell that. And when the price of the market's over our cost to produce, we're able to basically make a good amount of money and return that to the customers. We also have capacity requirements as part of MISO, and so we have existing generation on our system to meet our load obligations to MISO. So this represents our existing MPW generation units. I wanted to remind everyone we have 3 coal-fired generators. Unit 7 came into service in 1958 and is a 25 megawatt Stoker-fired machine. We have Unit 8 as well. That's a 75 megawatt cyclone boiler that's intended for retirement here in 2028. We previously committed to coal cessation for ELG guidelines, as Gage had mentioned, for both Unit 7 and Unit 8. But Unit 8, with the in service of EcoGen 10 here in 2027, is committed to retirement for our air permit. And then we also have Unit 9, which we've got featured over here on the right. That was put into service in 1983 and is a 175 megawatt pulverized coal-fired boiler. We also have wind. We've got about 13 megawatts of wind that we have contracted for via purchase power agreement out there in Jackson County, Minnesota. In terms of the background of how we got to today, I think it's important to identify that this has kind of been an evolution in the space of generation. 2019 had a lot of new environmental regulations, which placed uncertainty onto our existing generation fleet. And at that time, we looked into pending unit retirements, as well as the desire to basically expand into renewable portfolios. So at that time, we were evaluating solar photovoltaic arrays, as well as investigating a combined heat and power resource, or something that could be gas-fired to power the units past our coal that we have currently. In 2022, we continued that study, and we have a solar queue position, which is now Solar One, that was put into MISO in July of 2021. And we've also continued development of that small-scale chip unit, which became EcoGen 10 over there on the left. Finally, we pursued ELG compliance for Unit 9. It became evident at that time that the value of that particular generator was pretty extreme compared to all the other assets under consideration. And so we made some efforts to begin reinvesting in that coal-fired generator moving ahead. Here in 2025, we're still stuck with the MISO interconnection queue and waiting for Solar One to pass through the interconnection studies. We're currently under permitting and development for EcoGen 10, so things are moving very well for that project. And more recently, we've had more uncertainty. The 2024 EPA rules introduced new final requirements for greenhouse gas, which is air emissions, as well as effluent limit guidelines or wastewater emissions, in addition to MATS and other environmental rules. So that's kind of in contrast to the grid reliability that Gage just talked about. We've got a lot of issues out with MISO declaring capacity advisories and not enough generation on the market, and interconnection studies are still stuck up in the queue. So I wanted to talk a little bit about electrical quantities. I used this metaphor previously, and it represents a parking lot. It's a good example of how we can represent capacity and energy as electrical quantities as a metaphor. So the parking lot serves as the peak requirement that you would need on the system for any given day, and that's something that we could call capacity. So let's say you're having some type of graduation event where everyone's needed to basically come to the high school. You have to have enough parking spots to serve that. And so for us, that's about 156 megawatts, which represents our planning reserve margin requirement. On the right-hand side, we have energy, which is the average or the current number of cars in the parking lot at any given time. That kind of represents the Muscatine area load. And for us, that's about 104 megawatts per hour. So good context there. And that's a good reminder that all assets have different electrical quantities as well. So our base loaded assets like EcoGen 10 are able to basically provide a really strong level of capacity accreditation, as well as a high annual average energy output. Whereas your intermittent resources, such as solar and wind, have decreased accreditation because they're not available when they're needed most. Solar produces energy when the sun is shining, and wind produces energy when the wind is blowing, and not necessarily at the peaks of the system. Likewise, for EcoGen 10, we have our peaking units, which are able to provide energy when the power is needed most by the system, and so those are peaking assets. They, of course, have lower annual average energy outputs because they're not always online. So with that, we've got enough of a context to kind of go into the study. We're going to touch on the resource portfolios that were built to assess the economics and the performance of each of those portfolios, and we'll review the results and recommendations that were provided to the board in August of 2025. So starting with Leidos, and this is their stochastic econometric regional forecast model. I wanted to touch this very briefly to kind of remind folks that this was a driven process. It's very, it's a simulated environment where the outputs are based on financial performance of each of the portfolios contrasted against one another. Largely what Leidos does is they take these stochastic models of all of the input curves, so that could be represented for the fuel curve or the energy market price or the capacity price, and they develop 50 stochastic futures and they average that out, and that becomes the study curve used in the model. In addition to that, we did sensitivity analysis, which included high gas pricing, low gas pricing, as well as high load. And those were used to basically assess how the portfolios would perform under different cases and different sensitivities. In particular, high gas and low gas environments have different results that they recommend for the system. The takeaway for this slide is that we have a 21-year planning period, and 18 discrete power supply portfolios were evaluated into the study. And each of those looked at 24 unique generation assets for selectability, as well as recommendations moving forward. This is the environmental and energy and environmental analysis flowchart. Largely what this does is it's a dynamic model. Leidos takes all of the assumptions that we build into the study, compares each of the portfolios, and outputs a dynamic performance, which is largely financial based. So each of the portfolios are economically contrasted. So assumptions development, I'm going to slow down a little bit here and kind of cover the context of the study and some of the things that we made as assumptions moving forward. So the key assumptions are largely the greenhouse gas rule and some of those environmental policy considerations, predominantly the greenhouse gas rule, which is extremely important to the decision making that we make at Unit 9, as well as some of our other units. We'll talk about system loads and how that drove the need to look at some sensitivities, including a high load analysis. We'll take a look at market pricing and how fuel and capacity pricing drove the need for some sensitivity analysis with fuel price. And then we'll also take a look at the assumptions made for our existing generation assets. The first one that I wanted to touch base on is the greenhouse gas rule. And it's important to identify that we made the assumption that the greenhouse gas rule would, as published in 2024, would be either revised or repealed. And this is consistent with the activities from the from the EPA over the previous 6 months. So in June, they proposed the repeal of all greenhouse gas emission standards. They followed that up in July by issuing a reconsideration of the endangerment finding. And then finally, just this last month, they proposed reconsideration of the entire greenhouse gas reporting program. So these activities are all consistent with our previously made assumption that the greenhouse gas rule in its current state of 2024 would eventually be repealed or revised. In contrast, we have assumed that the ELG and 316B requirements, which cover wastewater and aquatic impingement and entrainment, would be required. So we've captured and included those capital costs into the study. So for Unit 9, or for example, Unit 7, if it needs any investments for environmental compliance, those costs were included. For system needs, we have an internal load forecasting committee that take a look at the demand and energy requirements of Muscatine through the planning period. We have a relatively modest compound annual growth rate of about 0.25% for both the demand as well as the energy, and that's pretty consistent with the previous 20 years. We actually hit our peak in 1999 and have had a pretty modest load growth since that point. As you saw on the slide that Gage presented, that's consistent with most of the system. And while we don't have a discrete load addition announced for Muscatine's area, it could happen at any time. And so it's important to evaluate how a high load sensitivity might impact our power supply. Third, we have our key MISO market activities, and these are extremely important. One of the major activities is the advent of that reliability-based demand curve, and that drove the higher clearing price for capacity this most recent planning reserve auction in 2025. In addition to that, they've included the seasonal construct as a requirement for all load-serving entities moving ahead. So as opposed to having an annual capacity accreditation, we now have to accredit each of our generation assets by season and have enough capacity accreditation by season to serve our load of Muscatine. Fourth, I wanted to talk about the changes in how renewables have been assessed by the market. In one particular note on the right here, seasonal capacity accreditation for solar is expected to decrease over time. That's due largely in part to the fact that a lot of solar assets are proliferating onto the market, which is a good thing. However, they push the need for the demand of solar energy to later in the day. And so those assets themselves are accredited a little bit less and less each year as more and more solar assets come onto the system. So that's important when it comes to meeting the load requirements of Muscatine, because it's not just energy requirements, but it's also capacity requirements. Fifth, we have our trends and market price forecasts. So both the fuel price and the market price forecasts are expected to increase over time, which makes sense due to inflation and other drivers. But you'll see that the fuel price for natural gas outpaces the fuel price increase for coal by quite a bit. And in fact, coal is only 44% of the forecasted price of natural gas in the end of the planning period. So that made a significant impact on the value of Unit 9 on a coal-fired basis as opposed to conversion to natural gas or some type of coal-fired mechanism. This is a good representation of all those stochastic draws that were included in the modeling. So you have 50 stochastic runs here for the actual market energy price, and Leidos averaged each of those to develop the actual energy price clearing curve that was used in the simulation. Similarly, they did the same thing for the fuel price forecast, and you can see the difference between the high gas and low gas sensitivities to the actual natural gas curve that was used. So that black line in the middle there represents the base forecast that's actually used in the study. And we did a pair of sensitivity analyses and actually ran each of the portfolios across those sensitivities for the entire study to assess their performance and to see how they would perform in those environments. In addition to that, we have the projected fuel price for coal over the study period, and you can see that it's actually below the natural gas price, the lowest natural gas price assumed in the model. Important to note that this was prior to the One Big Beautiful Bill Act, which further reduced the cost of delivered coal to us. So that's reduced our price to produce by a further $1.50 or so. Here's a representation of the capacity price forecast over time, and you can see the sharp increase over the last year due to the reliability-based demand curve, and it's anticipated to be sustained. MISO's put out load signals and other types of indications that they do anticipate that the value of capacity should be retained by the actual clearing process. They issued a correction this previous year, but they didn't issue a correction to the process. They just issued a correction to the results because the way that they performed the auction matched what they intended, but didn't match the tariff. So without getting into it further, they do intend to clear it the same way moving forward, which is good news for generation owners. And then finally, there's been a lot of activity in the previous year based upon the results of the planning reserve auction and some of the reliability signals sent out by MISO. In fact, generation owners are planning to build about half of the renewable assets they had planned about a year ago, and they're planning to increase their dispatchable assets by over 56%. So now planned assets for development in both renewable and dispatchable spaces are about even, which prior to this, about a year ago, they were a 3-to-1 ratio. So that covers all of the assumptions put into the study, so we have an idea of kind of what we looked at and what we made as assumptions for the portfolios moving ahead. And I think it's important to note that we have 18 scenarios, as I mentioned earlier, and we have a dichotomy where we kind of evaluated 11 scenarios where the greenhouse gas rule would be repealed, and we have 7 scenarios where the greenhouse gas rule would remain intact, just to have a sense of what our strategy would be if those rules were to remain intact as they were published as final in 2024. On the right, you can see our sensitivity development. We have a high load sensitivity, a low and a high gas sensitivity, and then the ultimate prevailing case is our base load forecast. So in terms of scenario development, we had to kind of approach it in 2 separate questions. And those were largely, what's the best approach for Unit 9, particularly in the face of all the regulatory uncertainty, the greenhouse gas rule, ELG rules, as well as different drivers with maintenance and the age of the unit. What's the best fuel type for it, and what's the best method to serve Muscatine? It's basically our flagship capacity asset, and it's important to replace that in order to make sure that we're able to meet our load obligations for the system. On the right-hand side, we have the question of what's the best use of interconnection service for Plant 1, and we have expiring generators, Unit 7 and Unit 8, with the ELG commitment to basically cease burning coal by 2028. So we have an opportunity to reuse their interconnection service prior to them being retired. And so we wanted to understand what might be the best fit after EcoGen 10. What's the next best piece for the system? So we took a look at all of these generation resource candidates to understand which of these assets might be a good mix alongside Unit 9 if it were selected, as well as Unit 10. Unit 10, the Solar One project and our South Fork Wind Farm were all considered base assets in the study, our base portfolio. And so we wanted to understand what to put next to that in order to meet the best mix for Muscatine. So we took a look at all of our existing generators on different fuel types. We took a look at combined cycle units. We took a look at simple cycle CTs of different sizes, a whole host of renewable assets, including solar and wind, and we looked at solar in different configurations, including regional participation models, different sizes, and then even a hybrid model where it'd be a solar and battery project conjoined together. Finally, we took a look at fast-acting batteries, and we took a look at different types of batteries, including long-duration energy storage, as well as batteries that were able to participate in the real-time market. And then finally, we included recip engines as part of our analysis. So what did the results yield from the power supply study? Well, largely it spit out first which assets that which generation resource candidates were selectable and performed well in the model financially. And so starting with Unit 7 here on the left and Unit 9, these 2 existing assets were performed quite well in the study financially and serve as a good mix. Their existing infrastructure, and they're able to provide strong capacity accreditation against our loads. Unit 9 in particular was the best performing asset of the 2025 power supply study by an extremely wide margin. Following that, batteries performed quite well, and we have some internal questions about how to best realize the performance observed by the simulation model in the 2025 study. So that's one of our upcoming recommendations, is to continue to explore and evaluate that. The combined cycle unit actually was nominated as the selection or the replacement for Unit 9 as opposed to conversion to gas. And then renewables performed very well at the pricing assumptions made in the study, which is important. The One Big Beautiful Bill Act expedited the schedule for those tax incentives, which really put a driver on us to assemble these projects quickly in order to make sure that they make sense for Muscatine. On the right-hand side, we have the the two types of assets that didn't perform very well, long duration energy storage and recip engines or reciprocating engines, both failed to meet their capital cost of investment. So finally, we have this short list of the recommended scenarios that we presented to the board in August. And there are some similarities between the short lists here. All of them include Unit 9 on coal. And then aside Unit 9 on coal, we've got a small mix of flexible assets, including EcoGen 10 on gas, solar assets, and then Unit 7 or a battery project were recommended. 1H performed the best economically, but it had a little bit more of a risk profile due to the performance of the batteries, which varied in different sensitivities. And then 1C was what was ultimately recommended to the board in August due to its Unit 7's flexibility in terms of providing capacity accreditation in the near term and then extending interconnection service to when we were able to best develop a secondary project to that. One of the ways that we developed that shortlist was by setting the expectation that all configurations in the model would meet our reliability requirements, which was to serve our capacity requirements for Muscatine. And then we took a look at the next part of our balanced portfolio, our balanced model of affordability. And so each of these shortlisted models were largely the best performing models from an affordability perspective. So they all performed the best financially. We then took a look at narrowing down the shortlist in flexibility and sustainability. And so you can see, oops, I skipped a slide, but you can see that we narrowed down the short list with flexibility and sustainability, and that 1C portfolio provides really strong flexibility with having both fuel flexibility as well as interconnection flexibility, and as well as providing us some good attributes in sustainability with increasing our renewable penetration and reducing our carbon reduction, or increasing our carbon reduction. These are the projected carbon dioxide emission reductions over time with the recommended short list of portfolios. And we're still trending in the right direction. You can see here that we've got scenarios 1, 1C, 1D, and 1H, which are that short list of portfolios here, largely consistent with that 2-degree sea rise. And then we've got scenario 1Z, which we took a look at as well, which basically provides for negative 65% carbon reductions. In order to meet that target, however, we found in the study that there would be an additional $101 million in costs. So we've avoided doing that for now, and we're pursuing the 1C portfolio. And then we also took a look at the 100% renewable strategy. You can kind of envision how the concert of assets out there on the system might lead to your battery sizing. So you've got Unit 10, which is a base load here in red, and you've got your solar and wind outputs shown in yellow and green. And a battery, which would be essentially here on the system in order to help us ride through those periods of intermittent generation, would need to be sized in order to meet our entire load for the 4-day period. So you can see that basically calculates a 94 megawatt battery, which is shown here in the following slide. And even for the long duration energy storage, which has that 94 megawatts of battery requirement, we have $162, which is about $100 per megawatt hour greater than our recommended cost to serve with our 1C portfolio. This does not take into effect some of these really important considerations, such as transmission, green hydrogen availability, as well as interconnection. We've been in the MISO interconnection queue for 4 years waiting for Solar One, so it would probably take quite a bit of time in order to interconnect all of these assets. I have a list of conclusions that I wanted to take away here from our sensitivity analysis and from a general review of the study, and so I can go through these here today. Customer takeaways include that the diverse portfolios perform best when we have a various mix of flexibility and different assets. Our current portfolio and proposed resource mix are robust across the sensitivities, and particularly they do really well aside from the extremely low gas case. A prolonged low natural gas environment seems to suggest that gas-fired assets would perform well. So a coal-fired asset like Unit 9 doesn't do quite as well over the planning period. Gas price trends and EPA greenhouse gas rules steer the selection between those assets, like I just mentioned, whereas high gas cases are going to really drive solar and storage assets, as you would expect. And then finally, excess capacity and renewable assets, as we just covered in that previous slide, really raise long-term costs to customers. And they're something that we'd like to avoid in lieu of the balanced approach that we've recommended to the board. So the bottom line is that flexible planning keeps the costs and reliability stable across the entire system, and that's basically how we recommended the portfolio. So in conclusion, we have our short list here. We can see that the 1C portfolio is relatively consistent across all attributes that we assessed, including reliability, affordability, flexibility, and sustainability. It performs the best in reliability, of course, as we have enough generation to meet our load, and we also have different types of fuel. And here's actually what was presented to the board as recommendations in August. We'd like to keep Unit 9 as a coal-fired electric generating unit and pursue that ELG compliance in order to extend its performance and life. We'd like to keep Unit 7 as a gas-fired EGU. It was committed to coal cessation by the end of 28, but it hasn't been committed to retirement. It's really a great asset in terms of its ability to meet our capacity requirements and also extend that flexibility for the interconnection to when we can develop another asset like a battery project or a third solar project. We'd like to pursue Solar 2 to optimize the replacement of Unit 8 interconnection, so that would become that next piece to sit next to EcoGen 10 in the replacement to MISO. And then finally, as I talked about earlier, we'd really like to research battery performance. We were inspired by the way that the batteries performed in the 2025 power supply study, particularly in the fast-acting margin, and we'd like to validate that performance through industry trends and through other investor-owned utilities. I have a few project updates with that in mind to go through for Unit 9, Solar 1, and EcoGen 10 very quickly. So for Solar 1, here's the latest schedule. We just completed phase 2 a couple of months ago, and we've been stuck in phase 3 for a few months while they've been redoing the models. There was about 1/3 of the generation that was entered into the queue in 2021, backed out at the end of phase 1, and about another third backed out after phase 2. So MISO's been scrambling to try to get the models to resolve. That's been basically the story the entire time. We've been stuck in delays for quite a while. For Solar 2, we actually have some really good activities running in parallel right now. So we've been developing production and cost estimates while we've been talking to customers about their interest in another project. We've additionally been evaluating the logistics of such a project via the injection studies that would be needed, taking a look at the electrical equivalency study in order to reuse our Grandview substation for that project. And then we've been planning for how that interconnection might go with both tax incentives as well as product development for schedule. For EcoGen 10, we've got a lot of questions we can answer following the presentation today, but I've got some visual updates. So this was early in the grading project. You can kind of see some of these photos from the C242 grading project over the last few months. And then I thought it'd be cool to show the progression of the grading over time. So you've got September here, we've got a blank field. This is right next to Unit 9 between us and the Kent Corporation across Dick Drake Way. Here is the progress as of November. You can start to see the ground starting to rise through each of those lifts that the Triple B contractor performed through the summer here in August. And then this is the current condition of the site here in September. This was taken not too long ago. Here's some additional images of the EcoGen 10 project so folks can get familiar with some of the major equipment procurement activities underway. So there's that site rendering one more time. We ordered a step-up transformer from WEG. It's a 40 MVA base-rated transformer. That'll step up to 69 kV to interconnect our project to the grid. Here's our Solar Titan 350 CTG, or combustion turbine generator. That's a 35 megawatt ISO rated machine. It can actually produce up to 43 megawatts under the coldest conditions here in Muscatine. And then here's our heat recovery steam generator, which is under order from Rentec. For Unit 9, I wanted to spotlight some of the major projects coming up over the next year. We've got FGD pilot testing, which concluded recently into zero liquid discharge pilot testing that we concluded recently, and we're now moving into a FEED project in order to advance the results of that test. We've got boiler tuning, which just completed, and we'll be implementing those changes to the boiler curves and our digital control system over the next few months as well. And we're planning for a 2026 turbine generator overhaul next year. The last one that we did was in 2018, and I don't know if you all saw any of the pictures of that, but it's extremely impressive to see that turbine generator taken apart. Here are the upcoming ELG compliance projects for Unit 9. So we'll be doing some work in the ground floor bottom mass transport water system in order to send water over to the FGD so we can begin evaporating that water and meet that zero liquid discharge goal. And we'll be doing that front-end engineering design or that FEED study in order to renew that water balance as well as the chemical balance and continue that project towards completion. And here's our last slide. It's a balanced approach. We've got our current generation there on the top, so you can kind of get a good list of the sizing and when things were put into service. Our planned MPW generation here in the middle, which includes EcoGen 10 as well as our Solar 1 facility. And then the study phase generation, which includes Solar 2 and Solar 3. And I should also add batteries to that mix, as well as all those assets that we included in our 2025 power supply study. So I can stop here. If we've got any questions, we're more than willing to take them.
I'll jump back up here and help, tag team this Q&A session. So I'll hit the easy ones and turn the hard ones over to Greg. But we covered a lot, obviously, and this is the very shortened high-level version. The board members saw a deeper version, so you're getting just the highlights here. But obviously, very comprehensive study process that we go through, and it really has turned into an ever-evolving study. We do a major reset every few years or so, but it's almost just a continuous process as so many things are changing in the industry. And it's difficult to make a long-term decisions. You're talking about assets that might have a 40, 50-year life. Unit 7 has almost a 70-year life, and we're recommending to continue keeping it around longer still. So you want to make sure that you feel really good about those investment decisions before you make them, and that's why we do so much sensitivity testing on these two, make sure how robust is that recommendation as things change from what we think is the base case today, which won't be the base case in the future. So with that, any questions? Yeah, Lisa.
When you look at the scenario analysis, do you look at heating and cooling degree data? Because we see that as a big driver of our energy use. I wasn't sure if that is a drop in the bucket for you guys, or if it actually makes a difference on demand.
So it's a good question. So the model doesn't specifically spit out like number of heating degree and cooling degree days, but the model is an hourly dispatch model. So like Greg was showing some of those spaghetti-looking charts, they're looking at 50 different stochastic statistical draws on things for what the load how the load might change year over year, and they're looking at every one of those stochastic draws as an hourly dispatch model. So I think that kind of takes into account that dynamic anyway. That's a good. I've never had that question come up. Yeah, I like it. Yeah. Erica might get a kick out of this. We used to show heating and cooling degree days on our bill, and over time we've all been like, most customers don't really look at that. And Sal always said, well, I look at it every month on my bill. He was a big proponent of that, but it has since rolled off. Joni?
I was just, it seems to me the last time I was here, kind of looking at the big picture, there was a plan, and I believe you just explained that the plan has changed, which to maybe retire Unit 9 or even 7, or get one of them completely out of the mix.
Yeah.
And add a bunch more.
Good question, Joni. I don't think the recommendations that have come out of the prior two studies have changed. Even going back to the last study, the recommendation for Unit 9 was to continue to pursue ELG compliance. Now, we did make the recommendation to cease coal combustion on 7 and 8 to comply with the ELG rule, and that is still valid. And now we have made the recommendation to retire Unit 8. And that was really, the ultimate decision came down to a couple of things. One was it was going to have to cease burning coal anyway, which significantly impacted its performance. But then with building EcoGen 10, to help with the air permitting for that to bring a new power project onto the grid, it helped to be able to net out the emissions from Unit 8. And then also to interconnect it onto the system. We talked about how clogged the MISO interconnection queues are. So to help get that on the system, there is a process where if you're replacing a retiring unit, then you can build something else and reuse that interconnection service without going into that big study queue process. And so we're planning to do that with EcoGen 10 for Unit 8. So those two things were really the ultimate kind of drivers to make the decision. Yeah, I think the close ones around here, Des Moines and Cedar Rapids. Cedar Rapids has two large projects that are in the works now that are pretty large-scale data center projects. We've entertained, opportunities that occasionally come about in Muscatine as well, looking at how we'd serve that. The challenge is that the ones that are wanting to build now are huge. They call them hyperscale, so they're looking at like 1,000 megawatts plus. we're 150 megawatt peak, and they want to add 1,000. So it's not to say it would never happen here, but it would take a significant investment in not only much more generation than what we have been talking about, but also transmission. So to be able to serve a large load, not only do you need the power generation, but the system, the transmission system in the United States has a tremendous amount of resiliency and redundancy to it. So it can handle the loss typically of 2 transmission lines or a generating unit transmission line and still serve all the load. So if you add a big load pocket, not only do you have to be able to produce that electricity, you need to add a lot of transmission to be able to serve it under multiple scenarios. And so those costs are significant. So not to say it would never happen, but it's a big one. Corley? Good question. Yes, it is possible, and we have considered that as an alternate path if this queue just goes on forever. And it's we could do EcoGen 10 and Solar 1. I don't think we could do Solar 2 with that, but it's kind of one of those difficult, you're always in kind of a difficult phase because if we just wait till the queue's over, that's probably still our better path. And then it gets delayed another 3 months. You're like, well, is that still the right answer? So yeah, it's a really good observation because it is something that we've considered. Right now, our current belief still is that I think it's our best path to do Solar 1 through the queue, get that done, which hopefully be done in the next few months, and then do EcoGen 10 and possibly Solar 2 through the replacement process. That sound right?
That sounds right. Yep.
Does MISO have any representation from MWs of the?
So, yeah, it's a good question. MISO has a very robust stakeholder process. So they have several different committees that are active in various parts of what's happening in MISO, whether it be resource adequacy, so capacity, or transmission cost sharing, all kinds of things. So members have the ability to participate in those stakeholder meetings. Most of them are in Carmel, Indiana, which is outside of Indianapolis. So we participate through a coalition, basically, of load-serving entities. And so we basically have a contract with a company that's housed out in Indianapolis, and they can vote on our behalf, as well as several of the other coalition members. So that's our way to kind of participate in the process through that coalition. And then also MISO has a board. And one of the things for a while, the Iowa Utilities Commission had a commissioner that was on the board or on the Organization of MISO States board. They have a voice directly to MISO as well, separate entity from MISO, but they have a voice to MISO as well. So I would say we don't have a strong voice directly as Muscatine, but cooperatively we try and provide input. Yes, sir.
I guess every day you look at changes in regulations and with the current administration and the bill, I guess you planning on keeping, how do you deal with that?
Yeah, I've seen it throughout my whole career, and I know it started way before that. I was going back through some annual reports from the 80s, like when Unit 9 was under construction, and the note from the general manager at the cover, of the annual report talked about these environmental regulations are always changing, and it's, that's what we continue to see. So it's nothing new, but it does make it very difficult. And I think these kinds of studies are important to help with that because we look at, well, what if the regulation stays? What if it gets repealed? What does that tell us is the best alternative? And they're not going to be the same answer. So which of these set of alternatives performs the best overall and is kind of future-proof, so to speak, depending on how those change. But the greenhouse gas rule was the biggest one we kind of sensitivity tested, but they're all changing constantly. Greenhouse gas, ELG, 316B, coal combustion residuals. So it is a lot. And I would say the amount of time and resources and energy that gets wasted chasing the back and forth, because you have to track what's happening with the rule change. You have to evaluate the draft rule. Then you have to evaluate the final rule once it gets final, and that's going to be different. Then you have to start building a compliance plan, and then you have to start building cost estimates for that compliance plan. You have to update your studies to show the new plan. and then 5 years later it changes, and you're doing the whole thing all over again. So it's very inefficient. We certainly don't have the answer for it. All we can do is continue to evaluate and try and make decisions that we think can withstand those ups and downs as best as possible. Rich?
With the sheer growth of the data centers that are going across the country, in Iowa especially, how does that impact with MISO and getting locked in with the organization with them, getting all this power?
Yeah, I think it's going to continue to be a bigger and bigger challenge. One of the things MISO just implemented is an ERAS process. It's an emergency resource adequacy study process because they're seeing some of these big one-time events happening. Maybe it's a major load pocket that's going to cause a resource adequacy issue if that takes place. And they know that, well, we can't wait 5 years to go through the normal study. So they're trying to implement this fast-acting study process for these kind of key changes. We haven't seen that play out fully yet. I think they're just opened up their first ERAS queue. But I think it's going to take a lot of dollars, not only just new generation, but the transmission upgrades that are going to be required. I think a lot of those will ultimately go on that new load. And some of these data center developers, it's like there's no limit to the checkbook on some of these because the outcome, the end revenue is so high that they can afford to pay a lot in upfront investment for that stuff. And so I think what you're seeing first coming up is where's their existing capacity? And then where's there maybe recently retired capacity that could be brought online? Like nuclear units, 3 Mile Island, Duane Arnold Station in Cedar Rapids is likely to get recommissioned. There's another one in Michigan that's being recommissioned. So where is there an existing capacity of some kind that could be more quickly recommissioned or brought back? Because they know getting truly new on is really time consuming and costly. Good question. Yeah, Mariah.
This is kind of just for my own curiosity, but what are the reasons for Unit 8 being retired even a little bit fewer than?
That's a good question. Unit 7 is like one of those just units that is reliable, just won't go away. I heard stories earlier in my career that they weren't putting any more money into Unit 7. It was retired, it was on its way out. They weren't doing preventive maintenance anymore. That thing's dead. And supposedly some of the employees went around and they made buttons that said, "Save Unit 7." And this is probably in the 80s. So it has been through several rounds. It had a retirement date in 2016, I think, that we then extended. The benefit is it's small. Stokered units are very robust, they're resilient. They're not as efficient, but they're easier to operate. And so it just has been a thing. And it has a lower environmental compliance requirements a lot of times because of its size. Certain rules only hit units that are 25 or larger than 25 megawatts. So sometimes it rides under that threshold. And so it continues to kind of pop up. Just when you think it might go away, you're like, this actually really could be a benefit to the system. So Unit 8's, the boiler is Cyclone technology. It's much more finicky to operate, much more sensitive to perfect fuel conditions, and it has higher emissions, so higher regulatory costs.
I'd also offer that Unit 8's interconnection service of 75 megawatts was what we needed for EcoGen 10.
Yeah.
And like you talked about with the air permit netting, it just made a lot more sense.
And gives us the ability to maybe add something else with EcoGen 10.
Yeah,
which is
7
nice.
wasn't big enough for EcoGen 10.
Yeah. Before we break into that, thank you so much for the time here. Oh, we'll get one more question. Okay. Oh, thanks.
And when you see all the changes, the fact that you've done all this planning, and you're ready to adapt to this change.
Yeah.
That's so
I feel like sometimes all we do is plan. Like Doug White would say, "You got the talking part done." Well, yeah, but it is neat to actually see we're moving dirt. We're moving these projects forward because we've talked about them a lot. So it's neat to see some things moving forward. But if we could, Greg, nice job today. Very well done. All right.